because there is that sentiment in the last couple of weeks, the current news cycle of we've been on this very strong bull run, this very strong price growth period in 2021. Is it set to continue or are we looking down the barrel of a correction? Now, I'm going to take you through the logic behind this because I want to remind you, we are property investors because we are taking a long-term perspective. We are looking at what we're trying to achieve in our goals, and then we are taking incremental and deliberate steps to achieve them. We're not speculators, we are investors. But that does not mean we don't want good, strong, short-term returns, not at the expense of long-term returns, both would be great. And we are then looking for opportunities to actively invest and to generate a return. All right, so property investment, it's not around speculation. It's not about booms and busts. It is about constructing a deal, and when we find that deal, executing our plan to take us towards our goals. So I typically, as time has gone on, as I've been an investor for longer and longer, do not get thrown around by the media cycles, but it is definitely a concern for many people. So I'm going to start here with this news headline. Westpac hikes the fixed rate for the second time in a little over 2 weeks. When you dig in a little bit deeper, the first time they moved it was by 0.21%, and then once again 0.1%. This is the 3, 4, 5 year fixed rate period. It's not the variable interest rate. It's the fixed rate period. So what that is saying is the bank is thinking that in 3, 4 and 5 years, they are thinking the interest rate is going to be slightly higher. Okay, not now, but in that time period. The vast majority of Australians prefer variable interest rates, and there's no mention of that changing. In the same period, it's actually been trimmed by some of the smaller banks. The vast majority of Australians are using fixed interest, and that has currently been trimmed. So this is media hype. This is sensationalism journalism of coming in here and causing this clickbait. So the 3, 4 and 5 year fixed rate has been increased, but the variable interest rate has even been trimmed by some of the smaller banks. Now that's not to say that the interest rates will increase. We're at record lows. They really only can go one way. But the RBA has been very consistent that they're not looking at increasing the cash rate until 2024. It doesn't mean that the banks won't increase it either, but there's a whole nother topic of conversation around how they can really move the interest rate independently of the RBA, and there's some limitations there. So really you've got to come back to the RBA, and they have been under this chairman very consistent in their statements and doing what they say they're going to do. And the RBA themselves are not saying, and they've been consistently saying this, that they're not increasing the cash rate until 2024. And that falls in line with the Westpac fixed interest increases. So really, is there much substance to this? Surely interest rates do need to be increased in the future. Surely property prices can't keep travelling at this momentum and growing at this momentum. But I don't know if the stop is just around the corner. Even Westpac Bank themselves upgraded their 2021, so this is 15th of October, they upgraded, so this is around the time they were increasing their interest rates, believe it or not, they were upgrading their property price growth predictions and still saying it's going to continue growing into next year, 6 to 8% across the capitals. So this is showing you've got to dig a little bit deeper. Westpac themselves are the ones that have increased the fixed rate. It's a minority of property purchasers use that anyway, but it's not talking about today's rate, it's talking about the future, and they are still bullish on property. Digging in a little bit deeper, that is the macro environment observations. Digging a little bit deeper into the actual properties purchased, because remember the capital growth of an asset, it's only one way that we make money out of that property. I myself, obviously we want the capital growth. We're not buying in Australia. We're not buying an Australian index fund of property. We are buying an individual dwelling on an individual street, and we control the dialogue in our favour. We don't have to buy in Melbourne and Sydney if we don't want to. We can hotspot, we can find those locations using data and research, which is what we specialise in, to find those locations where the cards are stacked in our favour. Because it's all about under and over performance. So even in a downward trending, macro doom and gloom environment, there are still some locations that are going through strong growth trajectories. And that is not a flash in the pan. It is 2, 3, 5 year trajectories with strong new projects and employment pipelines. Okay, but, so that's another point. The national headlines are just that national. We need to focus on a location and the property, and we need to control our own dialogue and grab the bull by the horns. But even then, the growth associated with asset is only one of the components to generate us a return. We want to make money when we buy. We don't want the vendor to make money. We want to make money. So we can make money when we buy. We can purchase under market value. We can uplift the property in value through a cosmetic reno. I'm not talking about a big subdivision or a large value add. I'm talking about a good quality cosmetic reno where we spend money to make money and we create strong profit in that property. We want to buy a property that gives us surplus cash flow. So it's paying us to be in our portfolio. It has very strong yields, which generally means it has very tight rental markets. So it generally means if the economy was to correct, more people will pile into the rental side of the equation and our surplus cash flow is protected. So we've been paid to hold this asset through a stable price slowdown period. It might not go backwards, it might just slow down. But at least we're being paid to hold that property. But if we do our job finding a good location, it should weather the storm very well. And the growth is what we target and is what we all invest for. But if it doesn't happen, according to our plans, we've still made compelling money in other ways. So we've got to grab the bull by the horns. And for me, I take not a look at the news cycle and the media cycle, I look at what I'm trying to achieve across my portfolio, where I'm trying to get to, the construction of a deal to get me there, and then I look for properties that meet these numbers, and whenever you find that, it's a buy. Remember, I bought most of my properties in the GFC and the period soon after, 2007 through to 2010. That's when I was buying. And I looked and found deals that met my requirement and then executed on them. I was doing renos, I was doing all of this and that. I was paying 7% interest rates. Okay, not 3% interest rates, 7%, 8%, 9% interest rates, just to get a loan. I was making money in multiple ways and I was executing on my plan of attack. I think that's really important to mention because that question has been coming up quite a lot. We do need to bring focus into the longer term. We do need to bring focus into an asset class when we can control the variables. And more importantly, with property, when we profit through the property, we can access that equity and we can even use that to buy again. We don't have to sell the asset down like shares or even crypto to realize our gains. So the banks are willing to loan 90% LVRs to allow us to buy a property. And that in itself is an indication. When the banks are doing 90% LVRs, it means they're pretty comfortable about the direction that property prices are heading. And that's food for thought to, I think, leave that conversation on.